Have you ever looked at someone online saying things like, "I bought the dip. Tesla is going crazy. This stock just doubled my money." And secretly thought, what are these people even talking about? Because for a lot of people, the stock market feels like some exclusive club where everyone magically understands charts, numbers, and complicated financial words. But here's the truth. Stocks are actually one of the simplest wealth-building tools in the world once someone explains them properly. And by the end of this video, you're going to understand exactly what stocks are, why companies sell them, how investors make money, why people become obsessed with them, and how the entire system really works. So if you've ever wanted investing explained in plain English, this video is for you. And real quick, if you enjoy learning about money, investing, and financial freedom without confusing jargon, subscribe to the channel because we break down complex financial topics into simple ideas anyone can understand. Now let's get into it. So, what exactly is a stock? At its core, a stock is simply ownership in a company. That's it. When you buy a stock, you are literally buying a tiny piece of a business. Not pretending to own it, not renting it, actually owning it. Imagine your favorite company is a giant pizza sliced into millions of tiny pieces. Each slice represents a share. When you buy one share, you own one tiny piece of that company. If the company grows and becomes more valuable, your piece becomes more valuable too. And that's where investing gets exciting. Let's say there's a small company worth $100,000. If the company divides itself into 100 shares, each share would be worth $1,000. Now imagine you buy 10 shares. That means you own 10% of the business. So if that company eventually grows and becomes worth $1 million, your ownership becomes much more valuable. That's the basic idea behind stocks. You're buying ownership in businesses you believe could become more successful in the future. Now you might be wondering, why would a company even want to give away ownership in the first place? Good question, because building a company is expensive, really expensive. Businesses constantly need money. They need money to hire employees, create products, build factories, open stores, develop technology, expand into new countries, run marketing campaigns, and sometimes they simply need cash to survive. Now companies could borrow money from banks, but loans come with interest. That means the company eventually has to pay the money back, plus extra. Instead, many companies choose another option. They sell shares. In other words, they invite investors to become partial owners of the business in exchange for money. The company gets the cash it needs, and investors get ownership that could increase in value over time. Let's make this super simple with a story. Imagine there's a woman named Maya. Maya is obsessed with sneaker culture. She's been collecting rare sneakers for years, and now she wants to open her own sneaker store called Fresh Kicks. Not just a regular shoe store, but a premium store selling limited edition sneakers people can't easily find anywhere else. She creates a business plan, finds the perfect location, designs the store, builds a strategy, and after calculating everything, she realizes she needs $100,000 to launch the business properly. But there's a problem. She only has $50,000 saved. Now she has two choices. She could go to a bank and take out a massive loan, or she could bring in investors. Maya decides to divide her company into 10 equal shares. Since she already contributed $50,000 herself, she keeps 5 shares. That leaves 5 shares available for investors. Each share costs $10,000. One day, a sneaker enthusiast named Jordan hears about Fresh Kicks. Jordan loves the concept. He believes sneaker culture is exploding and thinks the store could become huge. So he buys 1 share for $10,000. That means Jordan now owns 10% of Fresh Kicks. 4 other investors also buy shares. Now Maya finally has the full $100,000 she needs to launch her dream business. And this is basically what investing is. People putting money into businesses they believe can grow. Now fast forward 5 years. Fresh Kicks becomes insanely successful. The store goes viral online. Celebrities start shopping there. Collectors line up outside new store openings. Maya expands from one location to 4. And the company that was once worth $100,000 is now worth $500,000. Remember Jordan, the guy who invested $10,000? Well, his 10% ownership is now worth $50,000. So if he decides to sell his shares, he makes a $40,000 profit. That's how investors make money when stocks increase in value. But this is where things get important. Stocks do not only go up, sometimes businesses struggle. Sometimes trends change. Sometimes competition destroys a company. Imagine instead that online retailers crushed Fresh Kicks. Sales slowed down, customers disappeared, and the company dropped in value from $100,000 to $60,000. Now, Jordan's 10% ownership would only be worth $6,000, meaning he lost $4,000. And that right there is the risk of investing. When companies succeed, investors can make a lot of money. When companies fail, investors can lose money too. That's why the stock market can feel exciting one day and terrifying the next. Now there's another way investors can make money from stocks besides just selling shares for a profit, and that's through something called dividends. A dividend is basically when a company shares part of its profits with shareholders. Think of it like a reward for being an owner. For example, imagine a company earns millions in profit this year. Instead of keeping all the money, they decide to distribute some of it to investors. So if you own shares in that company, you get paid. Some investors love dividend stocks because they can create passive income over time. Imagine getting paid simply because you own part of a business. That's one reason so many people become obsessed with investing. Now, you might be wondering, where do people actually buy stocks? Do they walk into some giant building yelling numbers like in old movies? Well, that used to happen, and technically it still does in some places. But today, most investing happens digitally. Stocks are bought and sold on places called stock exchanges. Think of a stock exchange like a giant online marketplace for company ownership. The two most famous stock exchanges are the New York Stock Exchange, also known as the NYSE, and the NASDAQ. Huge companies list their shares there so investors around the world can buy and sell them. And thanks to modern technology, you can now invest directly from your phone. No fancy suit required. No Wall Street office required. Just a smartphone and an investing app. That's one reason investing has become so popular over the last decade. It's more accessible than ever before. Now here's something a lot of beginners don't realize. Not all stocks are the same. There are actually different types of stocks. But the two main categories are common stock and preferred stock. And the easiest way to understand them is to think of them like regular tickets versus VIP tickets at a concert. Both get you inside, but one comes with extra benefits. Let's start with common stock. This is what most people buy. When someone says they own stocks, they're usually talking about common stock. Owning common stock often gives you voting rights in the company. That means shareholders can vote on important company decisions and leadership choices. The more shares you own, the more voting power you have. Now, most regular investors won't own enough shares to control a company, but technically, they still have a voice. Common stockholders may also receive dividends. But here's the catch. Dividends are not guaranteed. If the company has a bad year, they might stop paying dividends completely. The biggest advantage of common stock is growth potential. If the company becomes wildly successful, common stock can increase massively in value over time. But there's also more risk. If the company goes bankrupt, common shareholders are usually the last people to get paid. Sometimes they get nothing at all. Now let's talk about preferred stock. Preferred stock is generally more stable. Preferred shareholders usually don't get voting rights. But in exchange, they often receive fixed dividend payments. And here's the important part. Preferred stockholders get paid before common stockholders. So if the company distributes profits, preferred investors are first in line. If the company fails financially, preferred shareholders also stand ahead of common shareholders when money gets distributed. That's why preferred stock is often considered less risky. But there's a trade-off. Preferred stocks usually don't grow as dramatically as common stocks. So common stock offers more upside, while preferred stock offers more stability. Neither is automatically better. It depends on the investor's goals. Some people want maximum growth. Others want steady income. Now let's answer the biggest question of all. Why do people invest in stocks in the first place? Why not just leave money sitting safely in a bank account? Because inflation quietly destroys idle money over time. Let's say inflation rises 3% every year. If your money sits in a bank earning almost nothing, your purchasing power slowly shrinks. Everything becomes more expensive while your money stays almost the same. That's why many people invest. Historically, the stock market has returned roughly 7% to 10% annually over long periods of time. Not every year. Some years are terrible. Some years are amazing. But over long periods, stocks have historically outperformed regular savings accounts. And that's why investing matters so much. It allows money to grow, not through magic, but through ownership. When companies innovate, expand, and become more profitable, shareholders benefit. Of course, investing isn't a guaranteed shortcut to wealth. The stock market can be emotional. Prices go up. Prices go down. News creates panic. People get greedy. People get fearful. And beginners often make the mistake of chasing hype instead of understanding what they're buying. That's why smart investors usually focus on the long term. They invest in businesses they actually understand. Businesses they believe can survive and grow for many years. Because at the end of the day, buying a stock means buying part of a real company, not just numbers on a screen. And honestly, that mindset changes everything. Instead of gambling emotionally, you start thinking like an owner. So here's the big takeaway. Stocks are simply pieces of businesses. Companies sell them to raise money. Investors buy them, hoping those businesses grow over time. If the company succeeds, investors can profit through rising share prices and dividends. If the company struggles, investors can lose money too. That's the game. Simple in theory, difficult emotionally, but incredibly powerful when understood correctly. And the earlier people learn this, the more time they have to potentially build wealth. If you enjoyed this video and want more simple breakdowns of money, investing, and financial freedom, make sure you subscribe to the channel and turn on notifications, because we've got a lot more coming. And before you go, drop a comment below. If you could own stock in any company in the world, which company would you choose? Thanks for watching, and I'll see you in the next video.